Today, we will talk about cash conversion cycle, CCC. The cash conversion cycle is a metric that measures the time it takes for a company to convert its investments in inventory and resources into cash flows from sales. It considers how long each net input dollar is tied up in the production and sales process before it gets converted into cash received. This metric takes into account how much time the company needs to sell its inventory, how much time it takes to collect receivables, and how much time it has to pay its bills. The mathematical formula for CCC is represented as CCC equals days of inventory outstanding plus days sales outstanding, DSO, days payables outstanding, DPO. DIO and DSO are associated with the company's cash inflows, while DPO is linked to cash outflow. DPO is the only negative figure in the calculation. To calculate CCC, you need several items from the financial statements. The first stage focuses on the existing inventory level using the days inventory outstanding. The second stage focuses on the current sales and represents how long it takes to collect the cash generated from the sales using the days sales outstanding, DSO. The third stage represents the current outstanding payable for the business using the days payable outstanding, DPO. All of the above-mentioned figures are available as standard items in the financial statements filed by a publicly listed company as a part of its annual and quarterly reporting. CCC traces the life cycle of cash used for business activity. It follows the cash as it's first converted into inventory and accounts payable, then into expenses for product or service development, through to sales and accounts receivable, and then back into cash in hand. Essentially, CCC represents how fast a company can convert the invested cash from start to end. The lower the CCC, the better. CCC may not provide meaningful inferences as a standalone number for a given period. Analysts use it to track a business over multiple time periods and to compare the company to its competitors. Businesses can have negative CCCs, which allows them to hold on to cash for a longer period of time. CCC is also used internally by the company's management to adjust their methods of credit purchase payments or cash collections from debtors. Here are 3 key takeaways. 1. The cash conversion cycle, CCC, is a metric that expresses the length of time, in days, that it takes for a company to convert its investments in inventory and other resources into cash flows from sales. 2. This metric takes into account the time needed for the company to sell its inventory, the time required for the company to collect receivables, and the time that the company is allowed to pay its bills without incurring any penalties. 3. CCC will differ by industry sector based on the nature of business operations. Hope this would help. Thanks for watching.